Hi, Charles Sizemore here, and today we are bringing you the first video in a series of interviews we're having with the managers we use in our multi-strategy portfolios. These are managers we have specifically chosen for their independence, their rigorous risk management processes, and their lack of correlation to the broader markets. In this interview series, we'll be focusing on their processes, the ways they control risk, and what they're seeing in today's markets. So with that, let's dive in. Hi, Charles Sizemore, Chief Investment Officer of Sizemore Capital Management and co-manager of Blue Orbit Multi-Strategy. So one of the fundamental aspects of our process is we look for strategies that are uncorrelated or minimally correlated to each other. The idea is we want smooth, steady, consistent returns. And the best way to achieve that is by having multiple pieces that do not move together, what we call true diversification. So, to that end, we are interviewing today one of our core portfolio managers, Mr. Chris Antonio of Dipsea Capital. Chris, welcome.
Yeah, thanks, Charles. Great to be here.
Now, before we really get started, I do have to brag on you a little bit. I know it's probably foolish of me to tempt the market gods by saying this, but you founded your firm in 1995, and to date, you have never had a losing year.
Yeah, that's saying something like that is typically something that would tempt the market gods. So I respectfully I say we fortunately have not had that event up to now, but things are yeah, we certainly a lot of things we don't control, but that has been our orientation since leaving the floor of the stock exchange in 1995.
Well, so with a track record like that, that is evidence of very strong risk management, a focus on risk management, on minimizing the potential for loss. So why don't you kind of walk us through, what is your process? How do you approach risk?
Well, I think risk often reflects and success in the market reflects doing things that are in line with our kind of psychological makeup. And my personal psychological makeup is such that it's just I I strive for consistency that feels good. When I was drawn to the floor back in the 80s, my goal was the orientation of finding a way to generate return regardless of what the market was doing. So what there are a lot of ways to manage risk, but one of the ways we look at it is, and I'll go on a little bit of a tangent. My brother has been a zoo curator for 30 years, and he often talks about having multiple protocols if something out of the ordinary happens. And that's part of what we do here. Similar to at the zoo, if an animal gets loose, somebody calls the press, somebody calls the police, somebody gets the dart gun, somebody gets the you know the different tools one needs to deal with the situation. We do the same thing here. As one component of what we do is we have multiple tools in place to mitigate risk and to enable us to change when the market changes and says our positioning is no longer correct.
I like that. It shows that you adapt when you're not rigid, and you don't have this one view that's unchanging, and it's you adapt with the market you're in. So that's critically important, and that's why you've had longevity, I would say.
Yeah.
Now, no,
Oh,
go
sorry.
ahead.
No, I was just going to say, and you know, one other tangent that I think really comes into our success in terms of just risk management is is decision making in general. And I've done work with people in the academic realm that have studied people that are very good at forecasting, and that realm of people that have statistically forecasted well emulate exactly what you say, Charles. They're flexible, they're open to new information, they're willing to change their mind, they're intellectually humble, and all those things come into play as we manage our portfolio. We're willing to change when the market changes.
I remember one of the investor heuristics you had to look out for, one of the psychological biases we all have to look out for is the tendency to anchor and adjust. And
Mhm.
what that means is you have an original forecast or an original thesis, and you stick with that no matter what. The world's changing around you, but you stick to your thesis and you just sort of adjust it around the edges. When what you should be doing is starting each day, starting each trade fresh with, taking in the new information, the new environment you're in, and then formulating your investment thesis around that, as opposed to trying to make the world conform to yours.
I couldn't agree with you more. And again, going back to the work I've done with the folks that have actually done research for the government and with the CIA on forecasting, what they found is that you can almost have two groups of people, like pundits, who tend to be very black and white. They have an opinion and they sound so confident about their view. That's a very comfortable person to be around, but they tend to not be good at forecasting. Whereas those of us who are willing to change our mind when we get new data, uh, we tend to be less effective at cocktail parties because we don't have a black and white view. We have a more nuanced view. And again, that reflects just the ability to and openness to change our mind when the data changes. And when it comes to to certain cognitive biases, we're human too. So we try to design our models in addition to being self-aware of how we want to adjust. But we try to design our models so they embed a certain bias against cognitive biases. And an example of that, Charles, would be we tend to have our whole portfolio be very short duration. So one positive outcome of that is when is we don't have a chance to get married to our positions emotionally. We don't put it on and go, well, it used to be good. We still think it's good. Our inventory is in a sense rolling off every 24 to 48 hours for the bulk of our positioning. So that almost helps mitigate us getting really emotionally attached to a position.
Yeah, there's a fancy word for that one, and I forget what it is. It's the bias. It's not the ownership bias, but it's the bias where once you own something or once you're in a trade, it's yours. It's not just, you lose your objectivity and you become subjectively attached to it, almost like it's a romantic partner or something. So that is a real tendency among traders, and it's good that you know that, you understand that, and you mitigate that by creating a trading style that takes that out of the equation.
Yeah, exactly. I mean, it's so hard to do, and we all have those biases, and we all get rigid at times. And so we try to, when I was speaking of protocols, we try to manage and have a decision making approach toward flexibility and openness to new information. But we're human. Sometimes we're not. We get rigid, and also designing our models with a orientation that if somehow we do become more stubborn, our models are going to necessitate we're going to be getting out of problematic positions just by virtue of the duration of what we
Sure.
have.
I know I'm going to remember the name of that bias like 3 hours from now. I'm just going to like snap to attention and scream it out in public, and people are going to wonder what on earth is wrong with me. That's how. That's what.
Exactly.
But going backwards a minute, you pointed on something else I really liked. Another big bias in the world of trading is the overconfidence bias. And
Mm.
what you said was, that smartest guy in the room, who's the most interesting man at the cocktail party, he is often a terrible investor or a terrible trader because of all, for all these reasons we described. He tends to take very firm views, anchor into that view, and insist the world conform to it when that's just simply not the way the world works.
Yeah, absolutely. And again, these studies that have been done about good forecasters, one of the traits they look for and find in this 2% of people that year after year make really accurate forecasts is the concept of intellectual humility. That's what it is, and it's hard when there's people are very intelligent. They just assume they can transfer their fluency and efficacy in one part of their life into the markets, and the markets kind of have a uh, different rules of the universe operates differently in the markets than it does pretty much everywhere else.
That reminds me. So the financial writer Charles Ellis wrote a great paper, which he then expanded into a book several decades ago, actually, called "Winning the Loser's Game." And back then, and he was writing this more about stock picking and traditional mutual fund management, but some of the same lessons apply. His thesis was, look, this is like a game of tennis, except it's not like a game of tennis among two pros, where two pros duking it out, for just it eking out just 1 point here, 1 point there, and the better player wins. It's not necessarily like that in investing. It's more like amateur tennis, where you win by simply not making catastrophic mistakes. That's how amateur tennis. Like when you put a tennis racket in my hand, it's just a matter of time until I do something phenomenally stupid, right? And so when you're looking at bad tennis players, the winner is the one who loses less, the one who makes fewer mistakes at the end of the day. And Ellis said that that's kind of what investing has become, where like you basically win not by being smarter or by having some amazing tool that nobody else has. You win by being disciplined and not making mistakes. So he was talking about stock picking. I would say it's absolutely true in this world of options that we operate in, this world of shorter term trading. What say you?
Yeah, well, I completely concur with that, and I think I've built that belief around experience, and having done this for so many years. A lot of the time over many years ago, I would just be grinding it out over the course of the year, and it wouldn't really feel like we were making a lot of progress, but there was that kind of incremental grinding of return. And by the end of the year, it's almost like, wow, we had another good year. So I think that's one thing I've noticed over time is if again we using that old saying, if you find yourself in a hole, stop digging. And we find that if we find ourselves in a hole, we take the loss and we move on. And by the end of the year, things work out. And I think there was within the last couple of years, Jeff Bezos interviewed Warren Buffett and asked him, he's all, Warren, what you do doesn't seem very complicated. Why doesn't everybody do it and just try to, incrementally uh, build returns over time? And in fact, a big part of Warren's business is in a sense trading options. They're an insurance company. They're trying to make good decisions in terms uh, of risk and when to buy and sell insurance. And Warren said, well, the reason people don't do it is people don't want to get rich slowly. And just that concept, it's not sexy, but it works. And again, if we don't lose money, if we can just, go and plateau if need be while the market changes and we have to adapt, but we don't give it back, then over time it's a good formula, as evidenced by the concept of compounding returns.
Yeah, well, when you're not taking major losses, you're not digging yourself into a hole that you then have to get out of. I'm not gonna have the math exactly right on this, but you know the basic math. If you lose 10% in order to get back to break even, you don't make 10%. You have to make a little over 11. If
Mhm.
you lose 20%, I believe the math is you have to make about 25 to get back where you were. Well, if you lose 50%, you have to make 100 to get back where you were. And of course, the math just gets more and more challenging after that. If you lose, 75% of your money, getting back to break even is challenging to say the least, and it will take you a while. So by
Mhm.
having really good risk management in place, by not taking large losses, you're already starting ahead. You're not digging that hole. So yeah, you can swing for the fences. You can try to make that 20-30% year, but then you take the risk that you're going to have a significant setback that is going to then take potentially years to recover from. So, it's kind of a case of slow and steady winning the race, that the tortoise beating the hare.
Yeah, again, I'm kind of talking my book and in very much in support of what you're saying, but I think also from a psychological perspective, it's so hard to, and you see this with a lot of, the endowments and some of the big pension
The
funds.
endowment effect was the bias I've been trying to remember for the
Oh, okay,
last
there we
like
go.
20 minutes. Okay, that was it. I
Bingo.
told you I was just gonna scream it out like hours from now when it finally popped into my head.
That's right.
And
Good.
anyway,
I'm glad glad I
sorry
triggered
to
that.
interrupt.
Oh, no, that's perfect. But I went to a talk recently and there were a bunch of large pension funds, and one of the problems they'd run into is if the market's starting to sell off appreciably, or like let's say in 2008, and they started lightening up or adjusting their portfolio, uh, what ultimately happened is when the market did come back, they were somewhat underinvested. So it took them even longer to make that money back because they were, kind of being more conservative, perhaps
Sure.
when one would argue they shouldn't have been. But
Or in
again,
some
it's
cases, they
tricky.
didn't have a choice because they had taken losses. Their broker may have been less willing to extend the margin, may have been, their investors may have been trying to redeem. They may not have even been able to take the risk they wanted to because of the situation they were in.
Right, right. So, a lot of headwinds when you lose money, uh, not just mathematical, but also emotional.
Sure. Let's kind of fast forward more to the market of today. So of course you've been doing this a long time. You started your firm in the mid 1990s. So you were there for the dot-com bubble. You were there for the bust that came after that. You were there for the derivatives bubble there in the 2000s that of course ended in the catastrophic financial crisis in 2008. Yeah, you made it through COVID. You made it through the 2022 Fed interest rate spike. It's just kind of been one thing after another for the last several decades here. Looking at kind of crystal ball of where the risks are coming from going forward, one of the things that concerns me is this notion that perhaps we are reaching the end of the road for sovereign debt, for the U.S. For the U.S. debt position. We're about 36 trillion in debt right now. Of course, that's becoming kind of a political hot potato with a lot going on and with the big beautiful bill and all that. But the part that no one's really saying is whether that bill passes or doesn't pass or gets adapted or however that goes, we still have structural deficits that we don't have an answer for. So that bill changes things a couple hundred billion here, a couple hundred billion there, but we're still running deficits of well over $1 trillion, about trillion and a half, give or take a few hundred billion among friends, right? But yeah, there is this notion, there's this possibility in my mind that we do reach the end of the road where the bond markets finally revolt, where the government is no longer able to borrow at the rates it's used to borrowing at. And we go through some sort of spiral where we look kind of like Europe did back in 2010, 2012 when they had their sovereign debt issues, but arguably much worse because the dollar amounts are bigger and the US financial systems, of course, the linchpin of the global financial system. So the risks, everything's just magnified right now. You know, where do you see risks coming down the pipe? Like what keeps you up at night and what are you doing? How are you positioning yourself to prepare for that?
Well, there's a lot of risk out there. There's a lot of things that can go wrong. And as we operate in the markets, we try to be very aware of all those things that could go wrong. And in turn, all those things that can go right. uh, so the duration of our strategy such that we, as these major secular trends start unfolding in a certain way, uh, we're gonna they're not going to affect us in terms of how we're managing the portfolio because we can adapt so short term. But we tend to feel that, in other words, yes, we see those risks. What we tend to try to do is we try to look at like let's say that started to unfold, and all of a sudden, what a new phenomenon for a lot of people, but not for those of us who've been around a long time, is the concept of the bond vigilantes, the concept of this 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 subtle force out there that says, okay, game over. Let's say the U.S. You're not running your affairs prudently, uh, and so we're going to make interest long-term rates go up regardless of what you want and say. And so what I would the way we look at it is we're open to those scenarios, and then we looked how those would begin to manifest, and we're very respectful if all of a sudden, the 30-year bond really started to the yield on that really started to pick up. That would be a big warning sign for us to be even more conservative in how we operate short term. The other thing that I feel we're good at is with our history, we're good at asking the right questions, and we're good at seeing patterns. And one pattern I think is really interesting that I've seen, gosh, for 10 years, 15 years now, is it seems like the world is much more fragile, more prone to breaking very quickly, but it's also more resilient. It bounces back and finds kind of an equilibrium more quickly than it used to. So it just feels like we just have to always be open to kind of the good and the bad, the good coming forth, and we have to be flexible if that we start seeing that transpire, and equally if things start going the other way. But from the perspective of some of the issues that are out there, I would look for I'd be aware of it, and then we'd start seeing it manifest in the products we trade or in the markets. Then we're going to be even more respectful. And an example would be if long-term interest rates start picking up or the dollar starts losing more value. Those are going to be warning signs for us to be even more conservative in managing our portfolio.
Yeah, I like to hear that, and it kind of goes back to what you said originally, that because you guys tend to focus on things that are so short duration in nature, you guys tend to be you trade things very short term. How do you really lose money investing? You really lose money by taking large positions and buying and holding them until they run into the ground, right? So
Mhm.
by virtue of taking, many smaller trades, it becomes a numbers game. So, you're not going to take a catastrophic loss doing that, or it's extraordinarily unlikely, right? It's small risk with each trade, and then they add up to returns over time. So you're not swinging for home runs. You're swinging for a lot of base hits. If you get a double or a stolen base or some other good baseball analogy in there somewhere, great. But you can win a lot of games by doing that.
Yeah, that's exactly right. And the one example I'd see is like, people say, oh, well, bonds aren't risky. Well, Silicon Valley Bank found that bonds were risky if they put on a position and they were too concentrated and they didn't admit they were wrong some point in the process. And so, again, even if we're short duration or longer duration, we are constantly taking small losses, and we find that by the end of the year, good things happen when we do
And Chris, that's why we invest with you. You've been a
that. Thanks.
rock solid performer for us for a long time, and we don't expect that will change anytime soon. Chris, thanks for your time today. I really enjoyed this. I think our investors will find it very interesting to get a peek inside your trading mind, and I look forward to talking more.
Okay, fantastic. Great to be with you, Charles.